Today, we're talking about one of the most powerful tools in trading, the Fibonacci retracement. How does it work? Let's break it down. We have a clear downtrend, price making lower highs and lower lows. To find a potential retracement level, we use the Fibonacci retracement tool. We drag it from the highest point to the lowest point of the move. Now, watch closely. The key area, the golden zone, between 61.8% and 78.6%. This is where price is most likely to react. And look at this. There's an order block lining up perfectly with the retracement. That's extra confirmation. Price reacts, then we get a break of structure, signaling a continuation of the downtrend. Now, it's time to enter. Stop loss goes above the golden zone, aiming for a 1-to-2 risk-to-reward ratio. Did you learn something in this video? Let me know in the comments. Like and subscribe for more content.
Where will the market go next? You have 5 seconds to decide. Write your answer in the comments. Obviously, we have a hammer candlestick at the bottom of the move, and my followers know that a hammer candle is a strong indicator for a reversing market. It's a candlestick with a long wick to the downside, followed by a strong upper body with little to no wick at the top. However, as we all know, this isn't enough for us to place a trade. So I waited for another candle, and as I saw this second strong bullish candle, I was really sure the market would be going up a little more. Now you can place a trade right away if you want to be aggressive and make a little more money of this trade. However, I waited for a candle to close outside this inverse fair value gap. It's a 3-candle pattern with a gap in the middle, showing imbalance in the current price. As we closed above this inverse fair value gap, I was really sure the market would be going up. So I placed a buy position with my stop loss below the fair value gap, since going below would inverse my trade idea with a 1-to-2 take profit. And as you can see, this was a win.
This one candle can completely change your life. This is how you do. If you are overall bullish, you want to buy below the market open. If you are overall bearish, you want to sell above the market open. Here's what I mean. First, go the daily time frame. In this example, we are overall bullish with this candle. Go to the candle and mark the open and the close of this candle. Next, go to smaller time frame. This green line marks the daily candles open. This red line marks the daily candles open. Since we have overall's bullish price movement, we only enter if price goes beneath this green line. We want some type of sell liquidity that goes beneath the market open. Done? Next, we want price to show some sort of respect by making a break of structure like this. Done? Usually while doing this, price will create a fair value gap. Done? Wait for price to retrace back to this fair value gap. Enter here. Set your take profit at the market close and set your loss below this recent low. And just like that, you got a winning trade.